It is 9:47 a.m. The currency market has been open for 17 minutes. A small number on your screen begins to move, 0.12%, then 0.28, then 0.41. On the surface, the change looks insignificant, a tiny shift in the exchange rate between two currencies most people never think about. But inside your position, that movement translates into something else. $4,600,000. That is how much your portfolio has gained since the market opened, and the day has barely begun. You do not celebrate, because the number that matters today is not the profit. It is the number behind the trade. $1 billion. That is the capital currently under your control, not your money. But for the next 7 hours, it moves according to your decisions. 3 hours earlier. It is 6:12 a.m. Most of New York City is still asleep. The early morning light spreads slowly across the skyline of Manhattan. From the window of your office, the towers around Hudson Yards look almost silent. Below, the streets are nearly empty. But the markets are already awake, because the global financial system never truly sleeps. When London opens, New York City prepares. When New York closes, Singapore takes over. The system moves continuously across time zones, and today, inside one glass office in Manhattan, $1 billion is waiting. On your desk sits a Bloomberg terminal. It is one of the most powerful information networks in the financial world. The same system used by traders at Goldman Sachs, J.P. Morgan Chase, and hedge funds like Citadel. Every second, millions of pieces of information flow through it. Currency movements, interest rate expectations, government bond auctions, central bank speeches, corporate earnings, commodity shipments, all of it feeding into the same global machine. The $1 billion you manage does not belong to you. Some of it comes from pension funds like California Public Employees Retirement System, retirement savings for teachers, firefighters, and government workers. Some comes from university endowments, such as Harvard Management Company, institutions designed to preserve wealth across centuries. And some originates from sovereign investors like Norway Government Pension Fund Global, a fund created from decades of oil revenue. Those institutions trust your firm to grow their capital, and your firm has entrusted you with one strategy: global macro, currencies, interest rates, sovereign bonds, and today, one very specific trade. 5 years ago, you were not making these decisions. You were an analyst. Your desk sat 2 floors below the trading floor. Most of your time was spent building models, spreadsheets that attempted to translate economic complexity into numbers. Inflation forecasts, currency correlations, capital flow projections. Those models helped senior portfolio managers decide where billions of dollars should go. But your name never appeared on the trade ticket. You prepared the data. Someone else made the decision. 3 years later, you became a trader. Your job changed dramatically. You were no longer analyzing ideas. You were executing them. Large orders passed through exchanges like the Chicago Mercantile Exchange and NASDAQ. You watched liquidity move across screens. You saw how markets reacted to large flows of capital. And you learned something important. Markets are not theoretical constructs. They are ecosystems. Thousands of participants reacting to information simultaneously. When capital moves, the effects ripple outward. Understanding those ripples is the difference between profit and disaster. Now the decision is yours. The spreadsheet in front of you has been evolving for 6 weeks. Thousands of cells, dozens of assumptions, inflation data, interest rate expectations, political risk, trade balances, capital flows between continents. Inside the model sits a single thesis: a mid-sized economy, a central bank under pressure. Markets believe policymakers will delay tightening interest rates. Your model suggests something else. Tightening will come sooner. If that happens, the currency strengthens, and the trade begins to work. At 7:30 a.m., your team gathers. 5 people around a conference table. 2 analysts, 1 trader, the firm's risk manager, and you. The discussion is quiet and technical. Inflation trajectories, debt sustainability, political pressure, foreign investment flows. Each assumption tested, each scenario challenged. Eventually, the risk manager asks the question he always asks. What breaks the trade? You answer calmly. Political intervention. If the government pressures the central bank to delay tightening, loss potential, 2.3% of capital. Approximately $23 million. No one reacts. At this level of finance, numbers like that are simply variables.
At 9:30 a.m., the opening bell rings at the New York Stock Exchange. Liquidity floods the market. Your trader begins execution. $10 million. Then another 10. Large orders move carefully. Entering too quickly reveals your intention. Other traders see the movement and adjust their prices. Execution becomes expensive. So the order moves slowly, piece by piece, invisible. At 10:42 a.m., the headline appears. A central bank policymaker speaks at a conference. One sentence changes everything. Inflation risks may require earlier policy tightening. Within seconds, the statement spreads across trading desks around the world. Banks like Morgan Stanley and Barclays begin adjusting their positions. The currency strengthens. The market begins to see what your model saw weeks ago. Your position grows. $60 million, $90 million, $120 million, the full allocation. The currency climbs. 0.3%, 0.6%, 0.9%. Your unrealized profit approaches $10 million. You stare at the number for a moment, then close the terminal. Because watching profit rarely improves decision-making. There is a moment in every successful trade when something strange happens. The market moves exactly as your model predicted. Your research appears validated, your decisions confirmed. For a brief moment, it feels like control. But experienced investors know something important. Markets are not controlled. They are influenced. Thousands of participants react simultaneously. Banks, hedge funds, algorithms, corporations hedging currency exposure, central banks adjusting policy. Even with $1 billion, you are only one participant inside the system. The global financial system behaves less like a hierarchy and more like a machine. Central banks adjust policy. Banks allocate credit. Funds deploy capital. Currencies move. Interest rates shift. Information flows through the system continuously. No single participant commands the machine, but every participant influences it, including you. At 4 p.m., the market closes. The position remains open. Tomorrow, the trade continues. Perhaps it succeeds. Perhaps it fails. Markets rarely promise certainty, only probability. Later that evening, you walk outside. The streets of Manhattan are busy again. Restaurants fill with conversation. People walk home from work. Most of them have no idea that billions of dollars moved through these buildings today. And that invisibility is part of how the system works. Capital flows quietly, through markets, through institutions, through models built by people who rarely appear in headlines. Tomorrow morning, another portfolio manager will open another model. Another trade will begin. Another $1 billion will move. And the system will continue forward. Not because any single person controls it, but because the architecture of global finance keeps turning. At 6:12 a.m. tomorrow, your alarm will ring again. The Bloomberg terminal will glow in the dark. The model will still be open, and the $1 billion will once again be waiting for your next decision.